let's get to our guest investor today, Joe Culler from Columbia, South Carolina. Joe, as a guest investor, can you tell us a little bit about your experience as an investor? What are you investing in? How long have you been doing it? Give us a little history.
Primarily, I had always invested in the stock market, and being a banker and being in that environment, that was the way to go. And of course, we in the stock market experienced some trying times in 2008, and we all lost a lot of money on paper. But I continued to hold. And when my money came back in around 2014, I decided to make a change. I wanted to sleep at night. I wanted something with less volatility. So, I came to JWB through fortune builders, just like you all did. And they had helped me figure out how to take a stock portfolio in an IRA and use it to buy houses. And so that's what I did. I set up some companies and transferred the money into a bank account and purchased 3 houses in August of 2014. At that time, in fact, I was talking to Adam Eisman. He was on the phone with me on August the 15th. And JWB at the time only had about 600 houses in their portfolio. We talked and we went over the economy of Jacksonville. And, like I previously said, I picked Jacksonville out of all of the places that we were talking about with fortune builders because I could get in the car and drive down there and see what I was going to buy, what I had purchased. And so the economy looked great. And Adam put me in 3 different places in Jacksonville, put me in the north side, Arlington, and west side. I had a triangle. You can draw a triangle with my homes. They took care to make sure I was diversified even within that geographic area. After 8.5 years and traveling to Jacksonville when I can on tours and on every property turn, I come down there and I work with the property manager on, how we should refurbish the property. Here and there, we make suggestions, and sometimes they'll do what we say, and sometimes they count and say, we don't think you should do that. So we respect that. And throughout the process, my returns have been great. And, having 3 houses, you never have really a period of where you have a negative cash flow because you always probably have 2 houses up and running, even when one house might be down for a month. And in my 8.5 years, I don't think I have experienced more than 1 month of vacancy from each house. And then the property team, you really can't believe the organization, the systems they have in place. I mean, they have care teams that help the residents maintain versus that come up in their life so they can keep paying their rent. They have a good team that puts good tenants in your house. And they have 2- and 3-year leases. And the employee culture is unbelievable. They have very little turnover. And one time when my wife was there, we were, there for about a day and a half. And she was a real estate agent at the time. And she says, if we moved to Jacksonville, I would work for this company. So it's been a great run. There's not a negative thing to say about y'all.
Wow. Well, Joe, thank you so much for all those kind words. So, Joe, have you taken a look at your client ROI report lately?
Yes, I have. Lifetime is 6.79%.
Ooh, I love it. I love it. So any JWB client out there, it's going to start with your goals. And so, for Joe and Renee, I wanted to show you the goals that we collectively put together as a part of that plan that Joe was talking about in the beginning here. We always want to find out the client's why. And Joe, your why was supplemental income, and I'm assuming consistency. That's what drove you to building this portfolio? Am I right?
Correct. Back in the day when we were first starting, we just talked about the ROI. We didn't talk about appreciation. We just knew that would be gravy. We didn't even worry about that.
Exactly, because cash flows and the other profit centers outside of home price appreciation back in 2014, they were so good compared to the other alternatives. You didn't even have to think about home price appreciation at that point. You could earn, call it 6.5% returns for a cash purchase and compare that to what you could get in the stock market. And even without home price appreciation with consistency, you were winning. So that's really kind of the mindset that Joe had going in. But then what we did is we turned this into a defined passive monthly income goal here. And that's that $2,100 that you see there. Now, over 3 properties, that's $700 a property. Now, Joe, do you happen to know, and I'm only putting you on the spot here because you have such a high reputation right now about knowing your numbers. Do you happen to know what your income is on one of your properties each month right now?
Well, the total is $3,331.
There we
On
go.
all 3 properties.
There we go.
Not
So
bad.
$3,331. So it's about $1,100 per property is the net income that he receives per property. So when we built this in 2014, each property was accounting for about $700 of net income. So when we talk about how this asset class is like a fine wine and it gets better with time and how cash flows grow and grow over time, this is what you're seeing for Joe's portfolio. He was expecting $700 a month in cash flow in year 1. And now we're, call it 8-9 years into this, and it's actually at $1,100 a month. Pretty cool, right?
Cash flow tomorrow.
Cash flow tomorrow, right?
Love it.
And then, yeah, we can keep going there. So we've got our 3 properties here. And then I want everybody to see the properties that Joe purchased here back in 2014. Joe, thanks so much for allowing everybody to see the information here. You know, your purchase prices are incredible, but the reality is that was the market value in 2014. You know, so it's not like Joe was buying below market value. And just like Joe mentioned and Lee mentioned here, you know, when we're looking at the portfolio of the client who purchases the house for the property of the week today, in 10 years, they're going to look back and say at 218,000, they're going to go, oh my goodness, I got a steal. And the reason that I'm confident in that is because that has happened every single real estate cycle as long as we've been tracking home values. You just have to give it a full market cycle, which is, again, between 10 to 20 years. And that's how we know that's going to happen. The other thing to point out here is I thought it was pretty cool when we asked Joe, what did he love about this property? He looked at the picture, which, you know, for me is, it's not really where I want you to look. I want you to look at the numbers, right? But what I think is, yeah, I know you're a banker, Joe. But the interesting thing there is these are renovations, and, you know, clients today, investors today fall in love with only new construction. When we look at Joe's experience in his portfolio, you can kind of see on those small pictures there, those are all renovated homes, and they all look very similar to the one on the property of the week today. So great example of somebody who's having significant amount of success with renovated properties, which is why I love both renovated homes and new construction.
Did we talk about the fact that he purchased them all in cash?
I think that bears repeating for sure.
Yeah.
You know, Joe, why did you buy them all in cash?
Well, it's obvious. I took my money in the stock market and used it to pay cash for my properties.
I love it. So we're going to take a look at your highest return on investment for your properties. And again, this does not include home price appreciation. And then, of course, we'll take a look at the lowest performing one. This one on Beverly is your darling there, Joe. This is the one that's been performing for all those profit centers, not named home price appreciation, at the highest return, which is about 7.4%. Let's look at consistency here, though, right? What other asset do you see that, you know, almost every single, I mean, the only range here has been from 2.5% to 9.5%, right? You don't see any years where it's gone down. It didn't go down in 2020 when the pandemic hit, right? It didn't go down any other time. And he's had property turns that have come along. So when we're talking about consistency and why you purchase with cash, many times you wind up with a track record, with a return on investment trend over years and years and years that looks just like this.
There you go. All right.
And now let's look at the lowest return on investment. And the cool thing is, again, when you buy in cash, you have much lower variability. So the spread between your highest return on investment, Joe, and your lowest return on investment is like 1%, right? It's not very wide here. So this is the lowest one on Bloxham Avenue. And this one returns at 6.13% for your annualized lifetime returns. And what I can tell you, just actual quantitative data, is that rents have gone up significantly. Home prices have gone up significantly in that area. So this is one of the fastest growing neighborhoods in all of Jacksonville, and probably one of the state. Yeah. Zillow did a breakdown of the fastest growing neighborhoods, and I think this was in 2021. So the data might be a little outdated, but 9 of the fastest growing neighborhoods were in Jacksonville, and 32208, right around here on Bloxham, was one of those neighborhoods that was identified as the fastest growing in the state. So Joe, this is how we break down all 5 profit centers. So from 2014 until current, Joe, you've earned just a shade under $160,000 in net rental income. That's consistency, that's peace of mind. And that's what you weren't getting in the stock market. So super, super happy for you. It's really wonderful. This is not an example of Joe putting everything that he has into rental properties, right? He still kept some in the stock market, right? But he carved out a percentage that was going to bring him peace of mind because this is a more consistent asset class. All right, breaking down the other profit centers here. Tax savings, a big fat 0 here. Lee, I'm going to put you on the spot. Why is that 0?
That's 0 because it's in his retirement account, cuz.
That's right. That's right. That's right. That was a softball. That was a softball.
So I hit it at a park.
So Joe already is experiencing the tax savings because he's buying these properties in his retirement account. There's no additional tax savings that you get simply because of rental property investing in your retirement account. You already get it. So that's why that's a 0 there. Principal pay down. We love principal pay down, but you only get that when you have a loan. And so with Joe buying in cash, he did not get a resident paying off his loan for him. So that's why that's $0. But one thing he did get, and he got a whole lot of it, is home price appreciation. Joe, when you were first investing in this, look here, you have $268,000 in home price appreciation. Would you have expected that your gains from home price appreciation would have been more than your gains from net rental income?
No, I would not have expected that. I didn't even really think about it that much. I just knew, based on the history of real estate, I knew I was going to have the appreciation. And the important part to me at first was getting the rental returns, to supplement my other income. And in my case, even the rental income was gravy. I could take that money and put it in another savings vehicle, and is what I did. But it was like having a cushion to fall back on if you needed to.
It's fantastic. I think that's a perfect way to look at rental property investing, especially if you're investing with cash, right? The first criteria, we need to have solid cash flow consistently coming in. And after that, we can think about potential upside, which is what we have with home price appreciation. So yeah, man, you did a great job. Did a great job with this investment. Of course, inflation hedging is in your benefit as well. The CPI is still at 6.4%. That is still incredibly high compared to where it should be. And when we talk about erosion of capital, others who are not earning 6.4% are having their wealth and their paychecks eroded by inflation. You don't have to worry about that because your rents are going up and your home prices are going up. So your expected return on investment for all 3 properties when you made the decision to invest with JWB was a 7.2% return on investment. Your actual return on investment, Joe, including both profit centers that are working for you, is 13.4%. So we are 100% beating your expectations, Joe. We're beating them by a large margin, my friend. Congratulations.
Thank you, sir.
Now, Joe, you said that you had done all your own numbers. You're the banker, right? Like, how does this compare with the calculation that you made?
It's right on. It's right on. And I'm not really a financial wizard. I'm just an average person, average investor. It's JWB that made me not the average investor.
I tell you what, Joe, your sound bites are incredible. I don't know if you practiced this before, but between the financial wizard comment and that one, I think your legacy is going to live on, my friend.
Joe, the last thing that we like to show also is to educate our community around, where the value comes in this investment type. We talk about this a lot, right? This idea that the majority of the return comes from the home price appreciation, no matter which way you cut it. Normally, we talk about this Pac-Man and the mouth of a Pac-Man. This is a Pac-Man about to take a big old bite because you put it in your retirement account and you bought it in cash, right? So like all rental income is this big piece, but it's still, the majority is still home price appreciation, right?
What do you know?
Which is why we like to tell people to invest in a growth market.
60 to 80% of your total pie, you guys see this week in and week out when we go through these investor journeys, 60 to 80% is home price appreciation. So you have to pay attention to cash flow, but you can't get too enamored with cash flow. You Got to make sure it's a cash flow positive investment, but you have to pay attention to the market, just like Joe did.